Today's episode is presented by Public. Public.com has just launched its new high yield cash account, offering an industry leading 5.1% APY. No fees, no subscription, and no minimums or maximums. That means you can grow your cash with 5.1% interest with no strings attached. It's as simple as that. Again, that is 5.1% interest with no fees. 5.1% interest with no subscription, 5.1% interest with no minimums or maximums, and 5.1% interest with up to $5 million of FDIC insurance. Just 5.1% interest straight up, no strings attached. Sign up today at public.com/chitchatmoney. This is a paid endorsement for public.com, 5.1% APY as of December 20th, 2023, and is subject to change. Full disclosures and terms and conditions can be found in the podcast description. High yield cash accounts are available for U.S. members only.
Welcome to Chit Chat Stocks. On this show, hosts Ryan Henderson and Brett Schaefer analyze businesses and riff on the world of investing. As a quick reminder, Chit Chat Stocks is a CCM Media Group podcast. Anything discussed on Chit Chat Stocks by Ryan, Brett, or any other podcast guest is not formal advice or recommendation. Now please enjoy this episode.
The stock, which trades under the symbol E.L.F, closed at $26.50 in New York, valuing the company at $1.18 billion. The shares opened at $24 and rose as high as $27.40 intraday. E.L.F products are sold online and in roughly 19,000 retail stores in the U.S., according to the company. It counts Target as its oldest national retail customer, but also has agreements with Walmart stores, Gap, Old Navy chain, and CVS Health Corp. The company also had 9 of its own retail stores in the New York metro area as of August and plans to open more stores nationally in high traffic locations. For the 6 months ended June 30th, E.L.F reported a profit of $1.1 million compared with $2.7 million a year earlier. Revenue rose 29% to $96.8 million. E.L.F said it aims to expand its brand into skincare and other products, and that it recently introduced a skincare line priced at $4 to $12 per product. That is a little snippet from the IPO article from the Wall Street Journal in 2016. Brett is going to be talking about E.L.F Beauty today. I'm going to pass things to you here. I hope that gives a little bit of context for what the business was like 6 years ago, but suffice to say, it is in a very different position today.
That is correct. And Ryan, I should say, welcome in. Thanks for everyone from joining us today. This is Chit Chat Stocks. That was from September 2016. And a little update for you, Ryan. I think that's closer to 8 years ago than 6 years ago. We are in 2024. Yeah. Quite, 2016 doesn't seem, it seems like it was just yesterday.
Almost a decade ago.
Yeah, but we got a lot to cover today. For those of you that don't know, we are studying E.L.F Beauty, ticker E.L.F, stands for Eyes, Lips, Face. It was one of the hottest IPOs of 2016 at a time when the market was really coming out of that GFC slumber. We had those tax cuts coming in, and then stocks just started soaring until the pandemic hit. But if we fast forward 5 years after these really optimistic IPO reports, an oversubscribed IPO, stock was soaring on the day of its debut. We get to May 2022, E.L.F Beauty shares were actually below its IPO price, producing terrible total returns for investors while the broad market soared. During this time, the company saw stagnating revenue growth for multiple years, along with operating earnings, closures of 22 stores that were mentioned in that Wall Street Journal report, and they had the same CEO and management team with minimal strategy changes. And yet, starting in the summer of 2022, E.L.F Beauty's revenue growth started to absolutely take off, as well as its stock price. As of this recording, I wrote down that we're recording a podcast. We'll also have the written stuff there. Shares have enjoyed a 29% compound annual growth rate since the IPO, despite most of the time going nowhere. And since May 2022, Shares of E.L.F. Beauty are up 667% in less than 2 years, making it one of the best performing stocks of the past few years. I'll have visuals for people that don't know in our newsletter, though the link will be in the show notes that you can subscribe to, get all the visuals of this stuff. And I think the big question is, and why I wanted to study this stock this month, is why. E.L.F. Beauty to me just seems like another brand out there in the makeup, cosmetics, skincare space. The products are incredibly cheap. You can get stuff for $2-3, and yet the stock is just on an absolute tear. So in this podcast episode, we're going to do one of our stock report styles that we've started out doing here in 2024, similar to our not so deep dives. I'm going to try to answer a couple of questions as Ryan leads kind of through an interview, a self-interview for the show here. What is E.L.F. Beauty? Why has the story rapidly changed in under 2 years? We're gonna do valuation work, what we can learn from the stock, and then close out with whether we think the stock is a buy at these prices. As always, Ryan, let's get started.
And you've alluded to the stock performance as of late. I want to kind of drive this home even more. Since prior to the pandemic, so January 2020, so this was before the business was, I mean, if you take it from its COVID lows, it looks really good, but this is prior to that. It is a 10 bagger within 4 years. I think it's actually an 11 bagger. So, and as you mentioned, it was the 4 years prior to that, it went nowhere. It was actually negative returns for 4 years, and then the exact opposite in the last 4. So we're going to go through some of that. I guess let's start with some of the history and lay the groundwork for listeners here, because myself, I had no idea what E.L.F. Beauty was, and you're going to talk about this here, but it's mostly popular with women. So any of our male listeners might not know exactly what the brand is. Why don't you go through the business and give some history?
Yeah, to disappoint the listeners out there, I guess we can't get much anecdotal evidence here. We're not going to go that far to try to drive growth on the podcast. Maybe some other people in our
some
lives.
surveys, if you want to call them that, so we can include that later on.
Okay, yes. So E.L.F. Beauty began in 2004, and it was a classic, I would say, 21st century brand story. There was a 23-year-old NYU student named Joseph Shama, beauty entrepreneur named Scott Borba, and Joey's father. They started the company. Interestingly, I thought that it was 3 males who would start the business, then it was a cult following among females, and today is still led by a male CEO, which I'd kind of think wouldn't work. And, are they truly going to understand the makeup market and the skincare market? And they started out basically the same as they position themselves today, as a, quote, quality cosmetics at a cheap price, originally selling products for just $1. And like a lot of disruptors of the time, it made its name online instead of in store. Here's a quote from a historical piece on E.L.F. Beauty. Quote, in a unique move, E.L.F. was born and sold only online, making it one of, if not the first, digitally native beauty brands. The positioning came out of necessity when Glamour magazine wanted to feature one of the brand's items on its pages, but couldn't unless it was nationally available for readers to buy. And then after gaining notoriety, E.L.F. Beauty won a deal with Target, which has remained its largest distributor ever since. And over the years, it has worked to gain distribution in places such as Ulta Beauty and Walmart, while also growing its online presence with its own D2C store and then Amazon shop. So what do they really sell? I mean, it targets younger female customers, think Gen Z, millennial, with cheap products that get the job done, but are still, good quality and have a little bit of innovation in them. Obviously, you want to try to make them fun and appealing for people to try out. So if I go to their best sellers on their website, they have a quote, Glow Reviver lip oil that costs just $8. There's a what is called a Cream Glide lip liner for just $2, a Halo Glow liquid filter for $14. I don't know what these do, but those prices are relatively cheap for stuff that you're going to use multiple times, right? And when they compare it to the legacy brands, think of L'Oreal, Maybelline, there's a lot out there. They're going to be significantly cheaper than what they call these prestige products. And it's not much more complicated than that. They have 24% of net sales coming from their digital sources, and then the rest from physical retailers. They don't have any of their own stores anymore. They shut those all down. And then if we go back to the history financially, in 2016, the company went public, as we talked about. Revenue stagnated, as we talked about. I have a lot of charts in the newsletter that people can check out here from our good friends at finchat.io. So if we look at kind of revenue from December 2017, revenue was $270 million. And then for the fiscal year ending in March 2020, they changed their fiscal year throughout this time period, but it's still a 12-month period. The revenue was just $283 million. So it had barely budged and was probably lagging inflation. Operating income looked even worse. Operating income was $25.6 million in December 2015, and then $24 million in the fiscal year ending March 2020. So up until the pandemic, nothing changed on that front. And I think at that point, investors were fed up with E.L.F. Beauty. They thought, okay, this is going to be subscale forever. In February 2020, there's actually an interesting E.L.F. Beauty short report written on Value Investors Club at $17 a share. It outlined reasons why they would continue to struggle, including the fact that they had little success in e-commerce at the time. Only 13% of sales at the time of that writing were coming from e-commerce, and they were beholden to the Targets and Ultas of the world. There was the closing of the DTC retail stores. There was the fact that the CEO was a, quote, strong seller of the stock. And then the fact, which was a headwind to the entire sector, I think this is really important to why people underestimated E.L.F., is that they needed to raise prices to combat China tariffs from 2019 that affected the entire sector. So I think the short report probably worked, or the short idea worked, because it was right before the March 2020 stock crash. And then there was also the headwind to the cosmetics sector, as people spent less time in person in 2020 and 2021, as we all know, meaning less need to wear makeup or less need to wear it as frequently. And that hit the industry during the pandemic. But as we know, from that time period, as Ryan mentioned, it was a 10 bagger, and from the pandemic lows, probably even much more. So what happened? I mean, I think one question we're going to ask multiple times here, Ryan, would you have any idea that this is a good buy at that time? Like, were there any indicators that this was a successful business?
No. If you look purely at the numbers from 2016 to 2020, this would not have caught my eye in any way. I don't short, so I wouldn't have been short, but I probably would have been pretty pessimistic about this business. They rely a lot on retailers. They're beholden to them. You talked about Target being a huge customer for them. So not a lot of, there's no pricing power. They are supposed to be the low-cost provider, but part of their low cost was going away with the China tariff. So it felt like there was going to be headwinds galore. So to answer your question, no, I don't think there would have been any way for me to think this is going to be an incredible investment. But something changed. So why don't we talk about the following couple of years? What changed in 2022, and what were investors missing?
Right. So in 2020, kind of the pandemic period, you had three headwinds that I'll say again. You had the cosmetic industry tariffs. You had the COVID-19 induced contraction for the entire industry. And then specifically for E.L.F., they had a heavy reliance on physical retailer versus e-commerce. So through March 2022, this made their growth look fairly meager. If we look at a chart here, they were growing sub 10%, and profits weren't really going anywhere. And importantly, I think this made investors underrate E.L.F. Beauty, even though they had started to gain a lot of market share in the United States. And the key is that they were getting market share, but growth didn't look that great because the entire industry was going through a tough patch. And at the time, we saw their EV to gross profit, which I think is maybe a fine proxy for valuation, just kind of using top line numbers. It was about 5, 6, maybe 7. It's fairly cheap. March, May 2022, we're getting down to 5, maybe even a little bit below 5. And then after coming out of the kind of reopening period, which made things a little volatile for the industry, there was the, like there's the reopening boom, probably, a lot of people buying stuff at one time, and then they kind of went through another patch of decelerating growth. They started posting phenomenal revenue growth, and it started showing up with earnings, with trailing 12-month earnings now at 100. I'm going to see if I get that right. Yeah, $144 million compared to, as we mentioned, $25 million just a few years back. And then for the stock price, the EV to gross profit has gone up to 16. So there you have it. That's the 600% return. So I think what happened here is I have four things. One, the cosmetics industry went from a headwind to a tailwind as the core younger consumers wanted to go out again after the pandemic. Second, there was pent-up savings from all the consumers during the pandemic, stimulus checks, no travel, huge bank balances. We've seen all those charts. Third, inflationary costs allowed e.l.f. Beauty to increase prices while still retaining the gap between the legacy higher priced products and incentivizing people to trade down, I would say, and try e.l.f. Beauty for the first time. And then fourth is management, I think, put on, and they continue to put on, a masterclass in marketing, which we're going to focus on a lot today. Before we move on, Ryan, any comments there before we talk about their marketing strategy?
Well, I wanted to do a double check while you were talking there, and this isn't necessarily around the tailwinds that you just mentioned, but it's about the stock price itself. You mentioned the incredible returns since 2022. This might blow your mind. E.L.F. stock since Jan 1, 2022, the returns have doubled Nvidia's in the same time
Really?
period.
Nice little check there, huh? What
No
website
one's
did
talking
you
about them.
what website did you use for that?
Oh, just I should say FinChat here, but I just Googled it simply.
Okay. But you can do
but
that. You can do that comparison quite easily with
yeah, you
FinChat
can.
that I look at. Use our link to get a discount in the show notes. There'll be an ad in the middle of this. That is shocking. Well, so Nvidia was kind of at a little bit of a peak.
Yeah, they were on their way down from. They were seeing volume declines at that time.
At that time.
And then if you take it from like 3 months forward, it's been incredible for Nvidia. But it just highlights how strong e.l.f. Beauty's performance and investors, how big of a swing investor sentiment has had for e.l.f. Beauty specifically, because you mentioned it. Not only did the results improve, but huge multiple expansion here as well.
Yeah, and that's, I think, a lesson broadly for people that are searching for finding these hunter beggar type stocks. You're not going to find many of them. If you're doing that strategy, don't expect. It's not easy. We've never found any. Well, maybe we haven't held any, but I think if you read the Chris Meyer book, the two takeaways are that one, you need durable revenue growth that obviously shows up in the earnings as well. And second, it is ideal to go from undervalued to overvalued, to see continual multiple expansion as the market starts to agree with your thesis. But let's go back to this marketing strategy, because I think this is important. They've gone from, in fiscal year 2019, only spending 7% of revenue on marketing, to fiscal year 2023 at 22%. And then this year it's going to be even higher. And they're doing that while growing their earnings. So it seems to be working. And it's the one thing here out of those that list I had that is out or not outside of management's control, essentially. And I think it's going to be the key to their growth over the long term. And it wasn't anything too crazy. They just seemed to put their marketing dollars where the puck was going, where their core customer was, and then turn up the volume on this marketing spend to drive profitable growth, compared to, again, some of these legacy brands that toss on those cable TV ads all the time that you've probably seen. For example, they have the top branded experience on Roblox with 4 million plays. They released a true crime parody documentary as an advertisement that has over 2 million views on YouTube and that people, think are quite funny. They have TikTok focused brand collaborations that get billions of impressions. And I think one of the keys is they were quite good at TikTok. And, as we saw over the last 3 to 4 years, TikTok has grown a lot in popularity. they have, and usually this is a red flag, but to be honest, these are very good commercials. They have very smart Super Bowl commercials that kind of explain, quote unquote, why you should use e.L.F. Beauty. For example, this year they had Judge Judy telling the court it should be a crime to overspend on makeup when e.L.F. Beauty exists, which I think is pretty, like, it's clear, okay, you should be using these products. Other people in the commercial, the attractive people they have in the commercial, the famous people are using these products, and they're saying, look, you can get the same thing for a third of the price. I think that's quite smart. And the
Do you
ROI they're
know?
getting here is fantastic. I should say that it has led to revenue growth accelerating to 85% last quarter.
Do you know the brand collaborations that you mentioned on TikTok? Do you think a lot of that is kind of the influencer marketing? Is there probably affiliate programs there?
That's part of it, but it's also stuff like a Chipotle or Dunkin' Donuts thing. They just did some, like, a special kind of beauty kit thing that had the combined logos just as a fun knockoff thing that's supposed to go viral, if you get what I mean.
Sure. All right.
But yes, they employ the influencer strategy. Yeah.
Okay. I would imagine because the makeup tutorials is huge across social media, especially on TikTok.
100%. 100%.
Seems like a perfect avenue for them that they totally succeeded at. So kudos to them.
Yep. And that's why, as I mentioned, they're spending a lot more as a percentage of revenue on marketing, but revenue went from 100 million to going to close in on $1 billion this fiscal year. And you have a lot more room given their gross margins to spend on that marketing and still, earn a lot of money. You can look at any of their earnings figures. So what's interesting though is they still have a lot of incremental dollars to invest in marketing, and I think probably get good returns. They are only at an unaided awareness of 26%. I believe that's in the United States. And there's a ton of opportunity to invest internationally, with only 15% of sales coming from these international regions, but growing quicker than overall sales. They just entered Italy and I think are already the number one product there, at least in a certain subsector that they care about. United Kingdom, Canada, places like that. I think they're doing a big European push over the next few years. And then I would say over the next 5 to 10 years, I would expect marketing as a percentage of total revenue to maybe start flatlining, maybe decline a bit, but that doesn't, the absolute, dollars are gonna grow and continue to go higher. It has now 4.5 million what they call Beauty Squad members. It's their loyalty program. They're pretty good at naming stuff. They say, like, I don't know how they say, they use like E.L.F. in all their stuff. It's like so elfing good, is kind of a nice quip, family friendly quip there.
That's nice.
Yeah, not bad.
It is. Yeah, it really is not bad.
Better than I would say, as the counter position, the legacy brands just do the same stuff with those ads on TV all the time. And they have, there are a lot of recurring spending coming from these 4.5 million loyal members on their mobile application, the D2C website. And I think it's a great asset and shows the really strong relationship they have with the under 30 customers of e.L.F. Beauty. And I think the discussion question I have here is, hindsight's perfect. We can see why the story worked, but was there any could you have seen this in early 2022 if you had followed the stock since the IPO and had it on the watch list?
If you were consistently following it, yeah, I think there were some indicators that they were seeing momentum and
the
that
market share gains.
The brand adoption was there. But the problem was, if I just screen for this, if I take a glimpse at it, pretty much any point between 2016 and 2021, I'm not going to keep looking at it. I would have omitted it already. Maybe this is a good chance. This is maybe where the girlfriend indicator is helpful. And I say that partly in jest, but when you start to see the adoption of, because a lot of the investors aren't able to keep up with all the social media trends, but we've seen this before where there are brands that get really good traction with a certain cohort, and that cohort likes to spend. So Lululemon's a good example. Starbucks has obviously been around for quite a long time, but there are certain brands that
I think
Dutch Bros. Trying to think of some other ones that might be. What's Aritzia? Is that the one that's done really well?
But that's a little bit dangerous because I you read as someone that doesn't buy these products, it's hard to have confidence in when the trend might be ending, and that's what we'll talk about makes investing in these difficult.
Before we move on, we want to talk about our friends at finchat.io. Finchat.io is the complete stock research platform for fundamental investors. Beyond having all the standard financial data for companies around the globe, they also have company-specific segments and KPIs on over 1,500 stocks. So if you want to see Amazon's AWS revenue over the last 10 years, or you want to track Match Group's paying users, maybe you're curious how many stores Sprouts Farmers Market added last quarter, FinChat tracks all those KPIs and literally 500,000 more. We know that if you're a fundamental investor, you probably track this stuff yourself, but this saves so much time and it has all the data you already need. If you aren't sure where to go, you can also simply ask FinChat. That is their conversational AI powered by FinChat's proprietary data. So that'll save you tons and tons of time researching. They've got stock screening tool. They've got fundamental charting that is best in class in terms of design. I use FinChat every day. I absolutely love the platform. Brett does as well. We both use it as our primary dashboard and the place where we do all our research. So if you want to get 25% off any paid plan, use our link, finchat.io/chitchat. That is finchat.io/chitchat. The link will also be in our show notes. Yeah, the point is, it's almost the Peter Lynch approach, which is, it doesn't mean you go blindly into any product that's getting good adoption from your friends or significant others or stuff like that, but keep your eyes open to it. And he did this all the time with his daughters and with his family. He talks about this in his book, where anything that was popular, he'd kind of keep his eye on. He'd go to the mall, he'd check out the store, and he'd really get the real world experience. And so I think maybe there would have been the potential to recognize it that way. Because if I'm looking at the financials, I would have glossed over this for 5 years. But if you're constantly following it, it's a different story. I think you could see the momentum if you're following it every quarter, but there are very few people that were doing that.
Yeah, I think the way you would build conviction, and we're kind of maybe not nervous about this, but saying it wouldn't have happened to us because we don't follow the industry and we can't get much anecdotal evidence, as opposed to maybe some products that more, males use. If you were following the cosmetics industry, I think you would have been able to understand that there was a lot of headwinds in 2019, 2020, early 2021. And then if you were someone that used the product or could see some of those trends on, as you mentioned, social media, maybe you could have gotten conviction with the stock trading at 10 to 15 times forward earnings, or maybe, some estimates there. But yeah, it could have been, I think, a good risk reward. And I think it's one that you maybe position size small, looking back on it, because today it could have turned into a large position. But let's continue. Anything else, Ryan, before we... Or go ahead.
There is a fine time period there where I would have maybe taken a startup position. And you could maybe do it today too, and we'll talk about that here in a second. But if you're looking at this from 2016 to 2020, I don't think I'm not walking away from it saying, well, maybe it's worth a startup position. Once you started to see that momentum and that revenue acceleration, yeah, but that really came in what, 2021?
Yeah, so their fiscal year is going to be a bit messed up, but if you look at the chart that I will have in the newsletter, remember their fiscal years end in the March of that year. So if we go up to the chart here, yes. So fiscal year 2022, the first quarter of that, which would have been the reopening period in the summer of 2021, they saw growth of 50%. I think that was just a comeback from the pandemic for everyone. But then it wasn't until fiscal year 23, which started in spring of 2022, when revenue growth started consistently accelerating. So spring 2023, so confusing with these fiscal years. Spring 2022, revenue growth 26%. Then by the end of that year, in March 2023, It had accelerated all the way to 78%, and revenue growth has been above 75% for the last 4 quarters. Yeah, I mean, that's when the momentum started. Is there a period in there when you could have invested as the multiple is still fairly low? Maybe, but yeah, as you said, when the market figures this out, it can be quick, and you have to have that conviction from, I think, the anecdotal evidence perspective first, because, the big investment funds are going to figure that out quite quickly.
All right, let's talk about the management team, because we've seen this story before where a brand catches fire and maybe it isn't necessarily durable. You really kind of got to have belief in the management team as well. So who are they? Talk about them a bit, and how important do you think they are to the thesis?
Yeah, so the rung by Tarang Amin, hopefully I'm saying that right, Amin. He joined the company 10 years ago, right before the IPO, and seems to have run the same strategy for years, betting on the future of social media advertising, going after the young female cosmetic shoppers, going for the DTC website, sticking with the low price point. From reading the transcripts, they have a strategy of having quality products with some innovation in there, trying to do unique, trendy stuff, that's going to fit well on viral TikTok, Instagram videos, stuff like that. Importantly, always price them well below the prestige competition, which has the legacy cost structures and very high margins due to decades of pricing power and price increases. Use unique marketing, and then repeatedly tell customers they don't need to spend a fortune on beauty products, and then also build a loyalty program. And if you look back at the stock in 2021, I think you would have said, hey, this could use an activist, right? Like, there probably would have been a lot of calls to get rid of them, bring in an activist investor. But I think what attracts me to this management team is that they stuck the course with this strategy, and it finally worked. The question I have is did they get a little bit lucky, betting on TikTok? Did they get a little bit lucky betting on Target, betting on Amazon, betting on their DTC website? Maybe a little bit, but I like that they had conviction in their strategy. They executed well, and they didn't sway through it because they had conviction that this was the future, even through some tough periods there. Anything else, Brian, before we move on?
No, I mean, there's some good fortune involved there. There were some tailwinds coming out of COVID, but they were positioned well to get lucky. They had the impressive DTC website. They were the low-cost provider. They had attractive marketing. That stuff is not chance. That was well done on their part. So probably some luck with just the tailwinds, but I think you got to give Amin here, the CEO, a pat on the back for sticking with the strategy.
Yeah, and after a period of bad luck. Okay, next part on management and culture is, I'm curious your thoughts here, because I really like how they treat all the employees as owners of the business. Here's a quote from a recent conference call. Importantly, all 300 of our employees are shareholders in E.L.F. Beauty, with a total employee ownership at nearly 15% of shares outstanding. Do you like this, Ryan? I like it quite a bit.
Yeah, they are certainly going to be well incentivized. Also, 300 employees, that is not a lot for the size of this business. I guess I don't know the market cap per se. It crossed 10 billion, right?
Yeah, well, let's look at revenue, billion. So the valuation has crept up there quite a bit now, but
a
revenue
billion
at
in
a
revenue
billion.
and just 300 employees, that's pretty impressive. So, if I'm an employee at the company, I would feel great. I'd feel motivated. I'd feel excited to work there. So I think that's a good strategy. Yeah.
And I think their efficiency is much higher compared to competitors, and it's not bad that your stock's been a 10 bagger. So people are quite probably financially set that work there.
And I guess I don't know the dilution story here, but I would guess that if you're a shareholder and you're an employee, one of my big concerns typically is stock-based compensation. But if 300 employees own 15% of the shares outstanding, they maybe don't want too much share dilution, would be my guess. So
Yeah.
it maybe forces them to moderate it a bit, but I could be wrong on that. I actually haven't looked at the numbers.
Yeah, and I think for any listeners, you hear us complain about stock-based compensation quite a bit. I think the number one gripe we have with that is heavy stock-based compensation for underperformance of the executive team. Now, I think I'm all for making everyone an owner in the business, and I think that can really help drive culture. But let's move on to the next topic. Some things I'm concerned about with management. One, dilutive acquisitions. Previously, they've bought two companies called Keys Soul Care, which was an Alicia Keys backed startup, and then Well People. Both seem to have done poorly. They're not talking about them at all anymore, and I think it's done quite poorly compared to the core E.L.F brand. These were small acquisitions looking at it now, but at the time they were fairly large. And then recently, they spent $355 million in a combination of cash and stock to acquire a company called Naturium, which is a skincare startup that's done fairly well. Time will tell if this acquisition will work, but we are already seeing in the first quarter after the close that E.L.F continues to accelerate and Naturium is underperforming that. Here's a quote from the conference call. We previously talked about Naturium contributing about $48 million for the year, and we expect that to be consistent. So our raised guidance really is reflective of the momentum that we continue to see behind the E.L.F Beauty overall. So they're saying that they're beating guidance because of E.L.F Beauty, but Naturium is doing just as they expected. I like this management team. I think they executed well. I think they can get revenue to efficiently grow. There's no question about that. But I have a lingering question which is, do they understand capital allocation and creating per share value? I would worry that they're a little bit of an empire builder of saying, hey, look, Naturium is a good asset. I'm not sure they're buying it at the right price. Is it worth to dilute shareholders from this incredible E.L.F beauty brand for Naturium, or however you say it? I'm not so sure.
Yeah, I wish I could walk back my previous comments here because it seems like they might be on that side of empire building, that they are potentially conflating getting big with driving value. And maybe it provides a bit of a safety valve to have multiple brands, but it can certainly be a waste of capital. Like, it could preserve them potentially if E.L.F starts to struggle to have these Naturium and Alicia Keys brand. But more often than not, acquisitions are bad uses of capital in corporate America. And my guess is these would probably be similar.
Yeah, and for behind the scenes for the listeners for these episodes, we do a flip-flop. So last time Ryan was the one researching and I was the one interviewing, kind of reacting as we go along. So Ryan has done minimal research before the show, and I'm the one that done the research. So it shouldn't be surprised that for anyone that, I know there's people out there that will complain sometimes if there's any slip-ups. Just that's on purpose. That's how we're doing these for these episodes. But let's move on. I think it's fun to talk about competitive advantage here, especially with a consumer brand.
Are there any?
Yeah, that's the question. So for first-time listeners, there's three things that we could try to care about at the end of the day. Do we trust management? Is the business predictable? And is the stock cheap? The second one is always a bit nuanced because we're really talking about competitive advantage analysis, sector analysis. There's a lot of variables that go into this one. I think after looking at Amin's track record and philosophy, I trust him. Maybe not perfectly. Maybe he's not on my Mount Rushmore of managers, but I think solid. It's not going to keep me away from the stock. When we look at competitive advantages and predictability, I think they have fantastic counter positioning versus the legacy brands. It definitely doesn't have, if we're looking at competitive advantages, there's not really any switching costs. There's no network effect. But I do believe it has a good brand competitive position. It can work. How should I say this? And they can develop economies of scale versus newcomers and startups that are not going to be able to price as cheap as they can with almost the same exact product. So if we look at brand position, I think they have a nice position in the market. The older prestige players are facing a bit of an innovator's dilemma. It's not exactly like E.L.F Beauty is innovating here. It's more of, okay, we can come out with the same product, but at a third of the price. E.L.F has come in, they've taken market share by offering quality products at a cheap price, but these competitors aren't doing anything. Like, the dynamic hasn't changed since 2017. And will this change over the next 5 years? I wouldn't bet on it. And they already are dominating with the Gen Z consumer, who is going to become a heavy spender of beauty products over the next 5 to 10 years. Here's a quote from a recent conference call. Our strength is the number one brand amongst Gen Z with an almost 29 share of them, as well as growing other audiences. So I think they are the number one brand among Gen Z. 29 share means 29%. I think that's quite high. Ryan, any thoughts on brand before we try to move into economies of scale, the price differences, stuff like that?
No, it's hard, I think, for a brand like this to really have any stereotypical or traditional competitive advantages, right? The network effect's not going to be there. They don't have like infrastructure type advantage like an Amazon. They don't have the distribution necessarily. They might have it relative to some of the smaller peers, but they don't have a distribution advantage over a L'Oreal or something like that. When we look at it versus like a startup brand, I think social proof is really helpful here, but that's not necessarily a lasting advantage. It can really reduce your cost of revenue and the marketing associated with having to attract new customers. But I wouldn't say there's any standard, typical advantage here. That's not why you're investing. Maybe there is at some point down the line, but today it'd be hard to pinpoint any.
Right. And counter positioning, innovator's dilemma, not necessarily the standard competitive advantage, but it can be a way where you can nudge yourself into a market and really, grow for a long period of time as they've been doing. And as I was saying, you mentioned, I won't read through all this because you kind of, said part of that. We don't need to repeat it. When comparing two startup brands, can any other startup in this space do a Super Bowl commercial? I don't think so. And the other legacy brands seem to be asleep at the wheel from a marketing perspective. E.L.F seems to run circles around them. So I think that's a great position for them to be in as the only new scaled player in this space. There might be another one, but I will say I'm not an expert on this entire competitive landscape.
I think the innovator's dilemma is real here. If you're L'Oreal, maybe they haven't even seen the impact yet. And to you, it's like, it's so hard to walk back pricing power once you've instituted it, especially if you're a public company and you're delivering results for shareholders. You have to answer to them every quarter. I think E.L.F is in a much better position that way.
Yeah, and what's also interesting is I think E.L.F Beauty has pricing power, even though they have to be a bit reactive to the Maybellines, L'Oreals, and others. I'm just always using those as the case study example here, as they need to maintain the gap in price. But if you look at the screenshots from the website above, you can get a product like the lip oil they have. You're going to use it many times, and it's just $8. I mean, will demand fall off at all if they raise it to $10, $12? I really don't think so. And the gap is still there, where if you look at their investor presentation, the average lip oil, whatever that is, I actually don't know what it does, but it's $40 at the prestige brand. So there's a huge gap there. If it's 12 versus 40, 8 versus 40, is that going to be a big difference for a lot of people? I don't think so. And it's not like this is a brand you show off outside. This isn't a luxury brand where you go, well, the Louis Vuitton bag is $2,000, but it's going to signal that I'm whatever, the best. And there's no addictive quality to a specific taste like a Coca-Cola, a consumer packaged good food product, cigarettes, blah, blah, blah. So I think it creates more of an opening for a brand like E.L.F Beauty to win. But conversely, I think it makes the entire sector more competitive. What do you think about that?
It's a good point because no one's saying, oh, she has on E.L.F Beauty lip oil. They can't tell. They don't know.
It's more personal.
Yeah. And so if you can drive the same results, which there is a little bit to this, right? Aesthetics is one part of it, but not having bad reactions to it. I know that's a huge part of makeup, like making sure that's actually okay for your skin. And if it checks those two boxes, right, it's okay for you and it looks the same, why wouldn't you pay 25% of the price?
Yeah. And I think there's a reason that L'Oreal is one of, like I mentioned, that the sector is a little more competitive, or I'd say opened up to more competition. But L'Oreal, I mean, there have been dominant players in here for a long time. I think the key question I have at the end here of this section is, can e.L.F. Beauty widen its moat over the next 5 years? I would answer yes, definitively. I believe it can. And I'd say all it has to do is keep doing what it's done over the last 5 years, and it will gain more power over the cosmetics industry, which will theoretically, lead to more profit potential. However, I would be hesitant to say e.L.F. Beauty has any sort of wide moat today. The brand is solid, as we've talked about. People get locked in, as Ryan just mentioned, psychologically to their consumer products. But there's nothing about this business that screams wide moat. The brand is not like a luxury brand or like we mentioned, a Coca-Cola type consumer product. There's no high switching cost software here. There's no economies of scale retailers like at a retailer like Costco or Amazon. This doesn't make it a bad business, but I think it will inform my opinion, and I believe should inform any investor's opinion on what earnings multiple I believe the stock deserves to trade at.
There are some, it's not necessarily like a switching cost, but once the habit is formed with a certain brand, it feels pretty rare that people switch. Because if it's working, if you feel good with the product on, there's not really that much incentive to change, and you kind of just buy it on a recurring basis when you need it, it seems like. So I would
And no one's
say,
gonna they're the ones undercutting price. So no one's gonna
yeah,
undercut them.
having that value with Gen Z, I would not be surprised if those customers stick around for a long, long time. And
Yep.
unless they just price gouge, which seems unlikely, uh, I imagine they'll be able to retain those customers.
Yep. And they have I love what they call the loyalty program, the Beauty Squad, at 4.5 million members now. I think it's growing 30% year over year.
Let's talk numbers. What do you think about the valuation today?
Yeah, so listeners will know that we keep things complicated with management and competitive advantages. We'll talk about that for maybe 10 minutes, but we keep it real simple on valuation to kind of answer that third question we go through. And I think with e.L.F., it's going to be two factors. What are operating margins going to be? What is revenue growth going to be? Revenue growth is probably the most important over the next few years. I ran a few projections with varying revenue growth and margin assumptions going out to fiscal year 2026, which is just 2 years of projections. So if you want to try to get funky, got 2028, 2030, be my guest. Today, e.L.F. Beauty is growing revenue 85% year over year with just above 15% operating margins. And I think continued growth at a lower rate and margin expansion is reasonable, especially with international push where they've seen quite, strong success there. I mean, TikTok, Instagram are global presences, and that's where their marketing function is. So they can push it into a lot of other markets. And with the cheaper price points, they can go into places like Latin America and not have a much problem. Here's a quote from them on their international presence as well. We're super excited about what we're going to be able to do in Italy and the response of the brand there. You will hear about additional countries in the coming quarters. I don't think you ever hear us talk about going into 30 countries all at once. So it's going to be meticulous, but there's a huge potential for growth there. And it kind of took a number out of a hat here and assumed 40% revenue growth under an optimistic scenario because 85% growth is not going to continue forever. And then under another optimistic scenario, I assumed 25% operating margins. And the way I did that is I kind of projected what operating income could be in fiscal year 2026 and then looked at the market cap today and said what the price to operating income would be. So if we go through it, under 40% revenue growth, 25% operating margins, the price to operating income would come down to 21 in fiscal year 2026 and would trade at 41 this year. Again, they're not going to do that margin this year. It's theoretical. And then if we assume revenue growth, I'm trying to be a little bit pessimistic. I know people love the stock, but you have to kind of go through some downside stuff. And I don't think 20% revenue growth is that unlikely. If we go down to 20% revenue growth for 2 years and then operating margin stays at 15% because they have to spend a lot of marketing, stuff like that, you'd be trading at 47 times operating earnings in 2026. And the question is, would e.L.F. be trading at 47 times operating earnings in 2026 under this scenario? I don't think so. I think it would be down quite a bit. And yeah, that's all my valuation work. It's nothing special.
I mean, if it slows to 20% revenue growth, obviously, and the margins stay similar, I think you're going to see some multiple compression, maybe some investors that kind of leave. Here's my issue, and I go through this all the time. I see a business like this where there is clear growth, huge ceiling, huge upside, and I sit there and look at the headline numbers. I look at the headline valuation and I say, well, if things go wrong, I'm kind of screwed.
Well, here's the thing.
Would you buy shares today?
Yeah. And the answer is no. I believe there's minimal upside for shareholders over the next few years and a lot of potential downside, because even under an optimistic scenario, what are you going to trade at a market multiple? You got to expect the stock to be trading at 40 times earnings. I mean, you can go through varying scenarios with the growth and the margins there, model out what you're expecting at this price. Is this price at a $10 billion market cap expecting 2 more years of 50% growth, 60% growth, and margin expansion? I think that is a tall ask, and you still might underperform if that happens. And I think the downside is quite high. If the multiple contracts, we could see the multiple contract back to a market multiple, and you could be down 50, 60, 70% within a few years if revenue decelerates. For this company, especially because I don't think it is a wide moat business today, and it's not a sector I know that well, I would buy shares if I was confident in durable growth and maybe an earnings ratio of 10 to 15, which is very far from here. And I think I would call this an incredibly risky stock at these prices to buy. I'm not saying it's guaranteed to do poorly, but buying today I think is a terrible risk reward. If you're a long-term shareholder and it's been a 10 bagger for you, I don't think there's any reason to sell, because, hey, you don't want to take the tax hit. They've done things so well. Okay, there might be a 50% drawdown, but it's still an incredible performer for you. But is it wise for someone to buy shares trading at this nosebleed multiple after such miraculous revenue growth? I don't think so.
I was going to say, what are the odds this is the next Celsius? Because it's kind of similar in some ways. But
Already was.
It already is the next Celsius, I guess, because it's already similar valuations, actually quite similar numbers, if I'm not mistaken, as well.
Yep, similar market cap.
There is a scenario where they're doing $10 billion in revenue in 10 years.
Yeah.
But there's obviously risk. There's a lot of risk that doesn't happen. And so I would say, my takeaway from your report here is that it's okay to have this. If you've owned this for a while, congratulations. I wouldn't sell it either. And the longer I've been investing, the more I've learned to just never sell my winners. I'm officially in that camp, I think. But if you're going to buy today, I would say do it pretty small. A starter position wouldn't be the end of the world here.
Yeah. It's going on the watch list. We'd see. It's a decent brand. They seem to be quite smart. All right, that's going to sum it up. Let's hit the disclosures. If you enjoyed this episode, if you got to where we are now, I would recommend to follow the show on YouTube, Spotify, Apple Podcasts, wherever you listen to these type of shows. Follow us on our newsletter to get updates on the show. Give us a 5-star review on Spotify or Apple Podcasts. It is the best way to help this free content and make it stay free for a long, long time. As a disclosure, we are not financial advisors. Anything we say on the show is not formal advice or recommendation. Ryan, I, or any podcast guests may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. Thank you, everyone. We'll see you next time.